Looking to see some sort of base, at least on the Dow this morning. Let's get to Shana Sissel, who is the CEO of Banríon Capital Management. Thank you so much for joining us today. Just help us out, because the market has been looking at the tariff fears, concerned that these tariffs are lingering more than they would hope for, that it's not perhaps just negotiation at this stage, but uncertainty starting to impact a lot of corporates. And we saw Delta, the first one to break cover yesterday, reducing their expectations now thanks to some of the economic uncertainty. How are you perceiving this market sell-off?
So I think that there is concerns about the tariffs for sure, but I think that feeds into a much larger picture where the concern really is about cracks in economic data here in the U.S., as well as the real risk of a stagflation environment, which is sort of a worst case scenario for the Fed. And so those things are giving people pause. Our employment numbers that came out last week had some concerning parts to it. And so all of those things are kind of leading to the market. So it's beyond tariffs, in my opinion. And I think it's warranted to feel this way. The tariffs will only accelerate a slowing economic conditions that existed prior to any of the new administration kind of coming into office.
Shana, the feature, though, this market, when we've seen concerns previously that there could be some slowdown coming, investors have hit out in technology names because a slower economy typically means lower borrowing costs. Those lower costs typically support technology, but we're not seeing that same level of support now. In fact, anything, these technology names are leading the sell-off. So how do you describe what we're seeing then in technology?
Well, that's exactly my point with stagflation, right? Because your point is that technology would do well because borrowing costs would go down, but that's not true in a stagflation environment. You can't lower rates in stagflation because you have potential for causing inflation to get out of control. So your tools to handle a slowing economic environment are kind of they don't work as well, and some of them you can't even use. And one of the policy things that you can't use is cutting rates in stagflation because of sticky inflation. So that's the real concern. That's why you're seeing, if you look at what sectors are doing really well, and then you look back at, say, the 1970s at what sectors tend to do well in that kind of environment, it's staples, it's healthcare, it's not technology, it's not discretionary. Those are the things that get hurt the most. And so for that reason, I think that's why you're seeing technology sell off. Plus the tariffs have a much greater impact on the technology sector than other sectors of the economy here in the U.S. And so that is also impacting technology stocks.
Shana, it feels like another way to describe what's been happening in markets is the end of the momentum trade. When you look at the stocks that have really performed poorly over the last couple of weeks, and I was looking at the Goldman Sachs Prime Broking report suggesting that hedge funds have been unwinding their positions aggressively. To what extent is this selling that we're seeing a result of hedge funds taking down their books?
I think a lot of the hedge funds were out of a lot of the tech names already. And while hedge funds certainly can take down their exposure, they tend not to have as much of an impact on the market unless it's related to their short book. And most of them weren't short the tech names. The largest asset managers here in the U.S. that would have that kind of impact on the market aren't selling these stocks necessarily. I do think that maybe in the short term, some of that momentum related asset managers, hedge funds or otherwise, that use algorithms that track the 12-1 momentum indicators and price movement might be getting a signal that there's a turnover in the momentum factor. And that could certainly be affecting not just the hedge funds, but also any sort of quant related long only manager as well.
Is the Fed put still in place? The president has been basically brushing off concerns around the market sell-off. And I think part of the reason investors were optimistic until recently was that they didn't think that President Trump would be willing to endure that much pain. But it feels like he's cast a doubt now on that position.
Well, I think a guest you had on earlier said it best. This is his second term. He's not running for re-election here. He very clearly had ideas that he wanted to put in place as soon as he got into office. A lot of it was about cutting government waste. It was about tariffs. That was a huge part of his campaign. And he has done exactly what he said he was going to do. And he's not really worried about what that means for the markets or the like, because he's not running, he can't run for another term. So he's less worried about how that will impact what happens next for him. He's more thinking about the longer term impact of how people will look back on him historically. And if the things he's doing now put America in a better place in the future, then he can kind of use that as his legacy. And I think he's looking at it from that perspective.
Shana, let me come back to some of the big tech names, because no doubt the tech bros are screaming at the screen that this is a once-in-a-generational change that we're seeing with AI. Even though we've got market noise, we've got concerns around the economy, we still have this generational change in technology. Apple is one stock you've been looking at. It was leading the market south yesterday, the worst performer for the S&P 500 and also for the NASDAQ, dragging both of those indices south. What's your view on Apple? Because some said this stock was more protected because it hadn't gone deeply into AI like other companies.
But that's the problem. They had plans to roll out their AI solutions this year, and then they came out and said that it's unlikely to be rolled out in this fiscal year, and now it's looking more like 2026. That's actually the problem with Apple, is that they are so far behind, and they had these big plans that were supposed to encourage people to go out and buy the latest and greatest iPhone, and now they're saying that that's not happening. So that whole upgrade cycle thesis is falling apart. And also, when you think about AI and CapEx spending, there's been a lot of calls where executives have talked about the outlook for their CapEx as it relates to AI going forward. But if there's a softening of the economy and growth slows down, those CapEx spending decisions could change. Just because you say you're going to spend X amount of dollars doesn't mean you're going to spend them tomorrow. And if you have to hold off because the economy is slowing down, you will. And so that's kind of, the vicious cycle that starts to happen right now, as we see a lot of concerning economic indicators and these tariff threats and the way that we're seeing retaliatory language as well from other countries suggests that this could be a bumpy ride for sure.
Shana, thank you so much for joining us so early in the morning. Shana Sissel, CEO of Banríon Capital Management.